Okay, Assalamualaikum warahmatullahi wabarakatuh. I'm Dr. Adli. Actually will be giving an online lecture on the topic of accounting and financial analysis. Um, Hopefully that we can benefit from this chapter 15 of the book that we have written on the title of Muamalat, Integration of Akli and Nakli. Right, so for introduction, basically, this is the chapter that is written by Dr. Zorina Shafi'i, Dr. Ain Ashikin, and also me myself. So basically, accounting and financial analysis. All right. So this is a very important topic that we have to understand whenever a company actually being uh, established. So we'd like to know whether the performance of the company actually is positive or is it negative. So the learning objective of today's lecture is actually to explain how firm use accounting, and number two, to explain how to interpret financial statements, and number three, how to evaluate a firm financial condition using simple ratio analysis. Right, so basically accounting is the summary of a company financial activities. Now, the process of accounting ends with a set of financial statement. So basically, financial statement provide detailed information about a company recent performance and its financial condition. So managers use the information to evaluate the company's strengths and weaknesses so that it can capitalize the strengths and make corrective actions if there are deficiencies. So this chapter focuses on how the accounting and financial analysis function can be used by companies to maximize its value. Now, for example, if you look at the real world, investors also uh, are interested to look at the financial statements of the company. They also rely on the financial statement to identify the fundamental value of the company. For example, if the company is listed in the stock exchange, we will actually evaluate whether the company is actually uh, having what I call it a good financial condition so that we can invest in the company itself. In addition, the government also would like to know how the company is performing because they are relying on the tax. Uh, so if the company make profit, the government would like to have to receive payment of taxes from the company. So it actually an income to the government. And also the public also would like to know the financial condition of the company, or whether the company, for example, the financial statement or the audit report and we call it the annual report, so that they can see that what would be the company can bring to the society uh, themselves. All right, now as as accounting provides financial information of an organization, and the process starts with bookkeeping, where daily and weekly transactions are recorded. For example, whenever the company made a sales, okay, they will have to record the sales transaction in the sales journal, right? That is one simple transaction. So you will do the we call it transactions, and all of the transaction must be recorded. So, but for a small company, sometimes they don't actually have the we call it the manpower to actually do it. So what they do is actually they will only keep all the receipts, okay, for example, all the expenses and so on, so that it will be compiled later on, and then uh, will be we call it the accountants or the bookkeepers will actually do it for a fee. This is for the small companies, but for normally for big companies, they have accountants that actually look into the accounting of the company. All expenses must be recorded, all income must be also recorded, and at the end of the day, financial statement can be provided that we can know whether the company is making profit or loss. And if we look at the process, so basically it starts with bookkeeping, where daily or weekly transactions are recorded. Then the end product of the accounting cycle is the production of financial statements. So financial statements uh, can be in terms of cash flow statements, can be in terms of the profit and loss statement, can be in terms of the balance sheet, right? So for the financial statement are important for reporting, for decision making, and also for controlling. For reporting is actually the financial statement is actually a mean to report whether the company is actually is doing good in the business operation, and also for the managers to make decision whether what would be the best thing for the company to actually improvise its operation and its revenue and so on. And also it can be used for a mean of to control the company. For example, if they are actually spending more on too much on certain areas, so probably they need to actually reduce the expenditure. And reporting is actually firm need to report all the relevant financial activities accurately in accordance with the generally accepted accounting principles. So this is GAAP, and also the Malaysian Accounting Standard Board (MASB), and also International Accounting Standards (IAS). So the use of common set of guidelines allow for more consistency in reporting practices among firms, and consequently meaningful comparison can be made between firms. So if we have a standardized, we call it accounting guidelines, so basically all the companies can actually what call it have like the similar or standard accounting we call it reports, so you can actually compare the financial results of company in a similar industry. For example, if you are looking at the construction industry, then you can identify which company is actually performing well and which company is not performing well from the financial statement. And for decision making, accounting data provide financial information to support decision making. For example, financial manager use past data for budgeting decision and anticipate future financing needs. This is done normally for every year, so we need to do the budgeting for the company. This is also the same thing for a national, for a government. They also do budgeting, and also for individual, we also do the like we call it our annual financial budgeting, so that we have like we know where the money goes and where the money comes from. And for controlling, basically, the financial information helps managers to monitor and also to control the performance of individuals, departments, and also products. This is done by evaluating and reviewing the financial statements. So we can actually identify whether our inventory are actually too large in our company, or whether the revenue that has been generated by a certain asset that we bought is actually productive or efficient. And also uh, since we know that the accounting is actually will produce financial statement, we need to understand how to read the financial statement. So basically there are two major components of the financial statement. The first one is the income statement, and the second one is the balance sheet. So before interpreting the financial statement, it is important for us to understand the information reported in both income statement and also the balance sheet. There is also another one, which is the cash flow statement, that is also equally important for us to understand. So basically, income statement is actually providing the bottom figure for the company, whether the company is actually making any profit or loss in a financial year or in a quarterly results. And for balance sheet, it's actually just looking at the company's financial condition, comprising of the assets that the company have, liabilities that the company have, and also the owner's equity that the companies have at a particular moment. And for the cash flow statement, it's actually the statement of the cash inflows and also the cash outflows. And we can actually identify whether the company is actually having positive cash flow or a negative cash flow, which is very important for a company to operate in the future. For example, if the company is having a positive cash flow, then we will be we'll understand that the companies actually do not have any problem with cash management. Okay, let's look at income statement. Okay, what is actually income statement? So basically, income statement reports the revenue or the income or the what call it all the sales revenue and also the expenses and also income and loss made during the accounting period, which is usually 1 year. But if you look at the stock market, for example, the companies in the stock market have to uh, report quarterly results, quarterly accounting. I mean, they have to make the reporting quarterly. So every quarter, 3 months, every 3 months, they have to report the we call it the financial result of the company. So basically, we have net sales, okay, which is the differences between our revenue minus all the expenses to generate the revenue. For example, the we call it carriage inwards and so on. Then we'll have our net sales. Then we have to identify what would be the cost of goods sold. Okay, the cost of goods sold is the cost of we purchasing the uh, materials that we want to we call it to sell. If we are actually we call it a retail industry, so we just buy the product and then we want to sell it back. So the cost of goods sold is the cost of that purchase. After we have that sales minus of the cost of goods sold, then we'll have the gross profit, which is the profit before we have to minus all our expenses, right? And after we actually get our cost of goods sold, then we will have this, what we call it, um, the uh, operating expenses that we need to deduct. So we need to deduct the operating expenses, we need to deduct the interest expenses, then we will get earning before interest and tax. So earning before interest and tax is basically all our income minuses all the expenses, but before we minus the interest and also the tax that we have to pay to the government. Interest we pay to the banks and the tax we have to pay to the government. After we minus the interest and also the tax, then we will get the net income, or in other words, we call it the earning after tax, the EAT, the earning after tax. So this is what actually a very simple, I call it theory of the income statement. And for a balance sheet, it's actually a report that actually provide the total assets and total liabilities and equity of the firm. So basically, the formula for a balance sheet is assets should be equal to the liabilities plus with the owner's equity. So these two sides will always balance. So basically, if your asset is 100,000, your liabilities and owner's equity also will be 100,000. So assets comprises of the current assets and also the fixed assets. So current assets are normally assets that can be converted easily to cash and also cash that and it's actually a bit liquid as compared to fixed asset. Fixed asset are normally long-term asset. For example, you buy vehicles, okay, for your company, or you buy a building for your company, or you buy machines for company to operate or to produce a product. And for liabilities, we can actually divide the liabilities for short-term liabilities and also the long-term liabilities. Liabilities is something that we owe to other people. So it's our responsible to pay back that owes the debts. So short-term liabilities are normally short-term within 1 year. For example, you are purchasing a worker in terms of on credit from your suppliers, then it become account payable. So account payable is actually a short-term liabilities, whereas the long-term liabilities are normally we acquire financing from the banks, and probably we acquire the financing to purchase the a vehicle or a building or machines that require more than 1 year for the repayment period. So that is considered as long-term liabilities. And the owner's equity is actually the amount of money, of the amount of capital that you actually, the owners, okay, or shareholders actually put into the company as capital. So these are the what you call it the elements of a balance sheet. So which are assets, liabilities, and owner's equity. So basically, asset must equal to liabilities plus owner's equity. Or I can say it R L. So R is for asset, L is for liability, and E is for equity. So R. And that is in terms of the two major we call it report statements in accounting, which is the income statement and also the balance sheet. And for the we call it cash flow statement, basically cash flow statement is actually looking at all cash inflows minus with the cash outflows, and then we get the surplus or deficit in the company. Any surplus must be invested in any we call it investment, and any deficit must be financed, and that deficit must be financed from financing from banks or using short-term papers. So we will continue on the ratio analysis in the next video, whereby we want to interpret the financial condition of a company by using a simple ratio analysis. So we'll see you in the next video. Assalamualaikum warahmatullahi wabarakatuh.